Big news in the insurance world.
Huge.
Arthur J. Gallagher. It's a big name, global insurance brokerage firm.
Definitely familiar.
They're acquiring AssuredPartners for a whopping $13.45 billion.
All cash.
All cash. That's a statement. What do you think? What jumps out at you about this deal?
Well, first, the scale of this deal is massive.
It really is.
This isn't just a big acquisition. This is history making. We're talking about the biggest sale of a U.S. insurance broker
Ever.
to another company ever. That's significant on its own. But it also tells us a lot about Gallagher's ambitions. They're not just playing in the insurance world, they're looking to dominate.
So let's talk about the player they're acquiring. AssuredPartners. For our listener who maybe isn't as familiar with the ins and outs of the insurance brokerage world, what is AssuredPartners all about? What's their specialty?
So AssuredPartners, they're an insurance brokerage firm too, but they've really carved out a niche in specific markets, like transportation, energy, healthcare, even government contractors. They're not trying to be everything to everyone.
They're going for specialized expertise.
Exactly. And it's clearly working for them. They've got a solid presence, not just in the US, but also in the UK and Ireland. This isn't a small local player. They're already a force to be reckoned with.
It sounds like Gallagher's making a strategic move here. They're not just getting bigger.
No.
They're tapping into AssuredPartners' specialized knowledge.
Definitely. Think of it this way. Gallagher's been a major player in the U.S. commercial middle market for almost a century.
Almost 100 years in that space.
They know that market inside and out. But by acquiring AssuredPartners, they're suddenly gaining expertise in these very specific, very lucrative sectors: transportation, energy, healthcare. These are industries with complex insurance needs, lots of growth potential. Gallagher's basically positioning itself as the one-stop shop for any mid-sized business looking for insurance in those fields.
You mentioned the middle market. It's probably worth unpacking that a bit. For someone outside the industry, what does that even mean? What makes a business a middle market business?
So in the insurance world, middle market refers to companies that bring in somewhere between $10 million and $1 billion in revenue each year.
10 million to $1 billion. That's a pretty wide range.
It is. It's a big segment, and it's incredibly diverse. You've got everything from manufacturers to tech companies to retail businesses, all falling under that umbrella. But the key thing is, this segment is growing fast. Middle market companies are becoming more and more sophisticated. Their insurance needs are getting more complex, and Gallagher is seeing that as an opportunity.
An opportunity to really solidify their leadership in that space.
Exactly.
Okay, so we've talked about Gallagher, we've talked about the middle market. Let's zoom back in on AssuredPartners for a moment. They haven't always been on this trajectory toward acquisition. They've had some interesting turns in their journey. Tell me about their history, particularly with private equity firms.
AssuredPartners, their story actually starts back in 2011. They were founded in partnership with GTCR, a private equity firm.
Okay, so private equity backing right from the start.
Right from the get-go. Then, in 2015, they were sold to another private equity firm, Apax Partners. But here's where it gets interesting. Just 4 years later, in 2019, GTCR came back into the picture. They led an investor group, and they bought AssuredPartners back from Apax.
So a bit of a back and forth with private equity.
Absolutely.
Yeah.
But even through all that, Apax actually held on to a minority stake. So they were never completely out of the picture. And there's another twist. Before this deal with Gallagher materialized, AssuredPartners was actually seriously considering going public, doing an IPO.
That is interesting. Seems like a very different path than being acquired. What made them ultimately choose Gallagher over potentially going public?
That's a good question. An IPO can be a long, complicated process. It can take a lot of time and resources. This deal with Gallagher probably offered them a more immediate, more certain outcome. They get the financial benefits without all the hassle and uncertainty of an IPO. Plus, they get to align themselves with a global leader in the industry.
So it's a win-win. They get the financial security and they gain the prestige of being part of Gallagher.
Exactly.
Okay. So now with this acquisition, Gallagher is going head-to-head with some really big names in the insurance brokerage world.
Oh, absolutely.
Arion, Marsh McLennan, these are giants.
Titans of the industry.
Paint a picture for us. What's the competitive landscape like right now? Who's making what moves?
It's a fascinating time in the insurance world. Everyone's looking to expand, consolidate, to get a bigger slice of the pie. You mentioned Aon, and they've been incredibly active. Back in 2021, they made a huge splash by acquiring Willis Towers Watson. That was another mega deal, further cementing their global reach.
So Aon is going for global domination.
It seems that way. Marsh McLennan, on the other hand, they're taking a slightly different approach. They've been focusing on acquiring companies that specialize in data and analytics.
So they're betting on tech.
In a way, yes. They're trying to be at the forefront of using data to assess risk and provide more sophisticated solutions to their clients. All these moves, they're pointing to one clear trend: consolidation. The insurance industry is becoming more and more concentrated in the hands of a few major players. It's a race to see who can build the biggest network, the most diverse expertise, and the strongest global footprint.
It's an arms race.
In a way, yes.
All right, let's talk money. This deal is valued at $13.45 billion, all cash. How is Gallagher financing this massive acquisition?
They've actually got a multi-pronged approach. They're dipping into their cash reserves, they're taking on some debt financing, and they're also issuing new stock to the tune of $8.5 billion. Plus, they've secured a short-term loan to cover the immediate costs of the acquisition.
So they're pulling out all the stops: cash, debt, stock offering, short-term loan.
They're going all in on this deal.
It makes you wonder what kind of impact this will have on their bottom line. Their adjusted profit will likely take a hit, at least initially.
Oh, for sure. Issuing that much new stock will dilute the value of existing shares, and taking on that much debt means interest payments. It'll be interesting to see how their earnings reports shake out in the coming quarters. This is a big bet, and it will take time to see if it pays off.
And speaking of time, when is this deal expected to actually close?
The target is sometime in the first quarter of 2025. It's not happening overnight. There's a lot of regulatory hurdles to clear, a lot of due diligence to be done. But Gallagher is already projecting some pretty impressive results. They're anticipating double-digit growth in their adjusted profit once everything's settled. They're clearly optimistic about the synergies they can create by bringing these two companies together.
So looking beyond the numbers, beyond the immediate impact on Gallagher, what do you think this acquisition means for the insurance industry as a whole? Could this be a catalyst for even more consolidation? And what does it mean for those middle market businesses that both Gallagher and AssuredPartners cater to?
Those are the million-dollar questions. And honestly, it's too early to say for sure. This deal could absolutely trigger a wave of similar acquisitions. If Gallagher sees success with this strategy, their competitors might feel pressure to follow suit, to bulk up and broaden their reach. Smaller, niche brokers might find themselves squeezed out, forced to either specialize even further or join forces with others to stay competitive. As for the middle market businesses, it's hard to say definitively whether this is good or bad for them. In theory, more consolidation could lead to fewer choices, less competition, potentially even higher prices. But on the flip side, they might benefit from a wider range of insurance solutions, more specialized expertise, and access to a global network of resources. It really depends on how Gallagher integrates AssuredPartners, how they structure their offerings, and how they position themselves in the market. The key for middle market businesses will be to stay informed, to really understand the shifting landscape, and to carefully assess how these changes align with their own specific needs and risk profiles. It's a dynamic time in the insurance world, and businesses need to be savvy to navigate these changes effectively.
It definitely sounds like businesses need to stay informed and adaptable. This is an evolving story that we'll continue to follow.
Absolutely. It will be fascinating to see how it all plays out.
Thanks for breaking it all down for us.
My pleasure.
Until next time.
See you then.